Welcome to the Deep Dive. We're here to cut through the noise, bring you the key insights from some really compelling sources. Today, we're diving into a pretty comprehensive 10-year total return forecast. It's for Vanguard ETFs. Our mission really is to try to map out what the next decade in investing could look like, helping you navigate, potential shifts and stay well informed.
Yeah, and what's really fascinating here, I think, is the central thesis. It's quite bold, actually. They're saying we're likely entering a pretty significant regime shift compared to the last decade.
A regime shift, okay.
Yeah, the whole era of, U.S. large cap growth stocks just dominating everything.
Right, FAANGs and all that.
Exactly, fueled by falling interest rates, expanding valuations. Well, that seems to be ending. This analysis basically suggests that what worked so well before, it might just not work for the next 10 years.
Not work for the next 10 years. Whoa, that's a big claim, especially for anyone who's, ridden that wave pretty successfully. So, okay, let's unpack this. How do forecasters even, begin to tackle something this complex, a whole decade of returns? Feels like predicting the weather 10 years out.
Yeah, it does feel a bit like that sometimes. But a robust forecast, it can't just extrapolate the past. You need a better framework.
Okay.
So for equities, the key for you, the investor, is really breaking returns into two core parts. First, there's enterprise return. Think of that as the fundamental business value. Dividend yield plus earnings growth.
Got it. The basics.
The basics, right. And then there's speculative return. That's all about the change in valuation multiples, like the PE ratio.
People are willing to pay.
Exactly. What investors are willing to pay for those earnings. And this speculative part, well, that's where it gets really interesting because it tends to mean revert.
Mean revert.
Yeah, so if a PE ratio is way up high, historically speaking, that creates a kind of mathematical headwind, even if earnings are strong. If it's low, conversely, it's a tailwind.
So it's almost like the market gets a bit ahead of itself sometimes, and then, gravity eventually kicks in. Maybe pack an umbrella for those high PEs.
That's a great way to put it, exactly. Now, for fixed income bonds, it's actually more straightforward. The starting yield to maturity, the YTM, that's easily the most powerful predictor. It's basically the total return you'd expect if you hold the bond till it matures.
Right.
And with the recent rate hikes we've seen, high-quality bonds, they now offer some pretty attractive starting yields. So fixed income is kind of back as a meaningful return contributor, not just a diversifier.
Okay, so the way we calculate potential returns is maybe shifting focus a bit. But what about the bigger picture, the whole economic landscape? What's the consensus, if there is one, for the next 10 years that's driving all this?
Well, there seems to be a pretty broad consensus forming around a new macroeconomic regime. Think higher structural inflation, higher interest rates, and potentially slower real growth than we saw in the last decade. But honestly, the most crucial takeaway for you is this expectation for significant mean reversion.
That term again, so things swinging back.
Swinging back. The last decade saw just massive outperformance by U.S. stocks, especially those large caps, growth stocks. Now these valuation-aware models, they're forecasting a reversal of those trends.
Wow, a reversal.
Yeah.
I'm genuinely surprised by that. Can you give us a sense of the actual numbers? What are we talking about for forecast returns annualized?
Yeah, absolutely. The analysis, it shows U.S. large cap growth ETFs, think something like VUG, Vanguard Growth ETF, which have led for so long. They're forecast to deliver only around 4.0% annualized nominal returns, just 4%.
Only 4, okay.
But then you look at the potential tailwinds for other segments. U.S. small cap value, like VBR, projected at 8.0%, pretty much. Emerging markets equity, around 7.7%. International developed markets equities, 7.5%. Heck, even U.S. high-yield corporate bonds are forecasted at 5.8%, potentially outperforming some equity categories.
4% versus 8%.
Yeah.
I mean, that's a massive difference compounded over a decade. That really forces a reevaluation. So, okay, what does this all mean for us, for the investor? What are the key strategic takeaways from these Vanguard ETF forecasts?
Right, and it's important to say this data isn't like a buy list. You shouldn't just run out and buy the top ones. But it is a quantitative foundation, a starting point for thinking about strategic portfolio adjustments.
Makes sense.
If you look at the top of the rankings in this forecast, they're dominated by international and emerging market equity ETFs. Something like VYMI, Vanguard International High Dividend Yield, that's at 8.2%.
Right.
Or VBR, the small cap value we mentioned, at 8.0%.
And the growth ones.
Conversely, yeah, the U.S. large cap growth ETFs like VOG, they're way down near the bottom of the forecast list.
Okay, those numbers, especially for emerging markets and small cap value, they are compelling. But let's be realistic, they often come with higher volatility, right? More ups and downs. How does an investor balance these potentially higher returns with those inherent risks?
That's absolutely the critical question. And this isn't about just blindly chasing the highest forecasted number, not at all. It's more about recognizing where the structural tailwinds seem to be strongest now. And yes, while those segments historically have shown higher volatility, the point of the forecast is that their expected returns are now significantly higher, potentially compensating for that risk.
So the potential reward is maybe finally matching the risk again for those areas.
Potentially, yes. It's not suggesting that companies in U.S. large-cap growth are going to suddenly stop innovating or growing. Of course not. But their current high valuations are seen as a significant headwind against future stock price returns. So the message seems pretty clear. Maybe reconsider a portfolio that's very heavily tilted towards U.S.-centric large-cap growth. The data strongly supports, or at least suggests considering, increasing strategic allocations to international and emerging market equities, and within the U.S. market itself, tilting more towards value and smaller capitalization companies.
This whole deep dive, it really highlights how crucial it is to look beyond just recent performance, what just happened, and understand the underlying drivers. So here's maybe a provocative thought for you, the listener, to consider as we wrap up. If the optimal portfolio for the last decade is pretty unlikely to be the optimal one for the next decade, well, what specific changes might you need to think about making to align your own long-term strategy with this potentially evolving investment landscape?
Indeed. It's like they say, the market often rhymes, but it rarely repeats exactly. And the real insight here isn't just knowing what might happen in the market, but maybe recognizing that your portfolio might need to evolve just as much as the market itself if you want to truly capitalize on whatever is coming next.